By the end of the session, we're hoping that you'll learn a couple of things, including understanding the tax implication of distributions from IRAs. I think most people are aware of the fact that distributions are treated as ordinary income, but sometimes the exceptions are overlooked. For instance, are there instances when distributions are in fact not taxable? And if so, how do you work with your clients to make sure that they do not pay income tax on those distributions that should be tax-free? We're also going to be looking at the required minimum distributions briefly when the 10% early distribution penalty applies, and some of the tax withholding rules and tax reporting requirements that apply. Now, generally, when distributions are taken from IRA, they can be done at any time. Up until age 70 and a half, an individual can take any amount from their IRA that they want to. However, if those distributions are taken before age 59 and a half, they're considered early distributions, and early distributions are subject to a 10% additional tax, commonly referred to as a 10% early distribution penalty. And I purposefully used additional tax here because if income tax does not apply to a distribution, then this 10% penalty does not apply because, as the term suggests, it's an additional tax in addition to what already applies. So if you're talking with a client and you're discussing the idea of the 10% penalty, to determine whether or not it applies, you want to look at the client's age, and you also want to look at whether or not the distribution is taxable. When an individual reaches age 70 and a half, they're required to start taking distribution at that point. For the year in which the individual reaches age 70 and a half, they must start taking required minimum distribution for that year and continue for every year after. We're going to provide a high-level overview of the R&D requirements as we go through the presentation. But I want to take a minute to remind you, though, that Roth IRA owners are not subject to the required minimum distribution rules, and I'm emphasizing owners here. From my experience, when I discuss the R&D rules with my clients, there's a tendency to forget that beneficiaries are subject to the required minimum distribution rules. And for Roth IRAs, because it is a known fact that Roth IRA owners are not subject to the R&D rules, some people do forget that the beneficiaries, though, are subject to the required minimum distribution rules. So if you have clients who inherit Roth IRAs, you want to make sure that you remind them that they may need to take required minimum distributions from those Roth IRAs, because if they don't, they are going to be subject to the excess accumulation penalty, which we will review during the presentation as well.